thank you. And Howard, that was an absolutely fascinating talk. But I wonder whether I can interpret your talk in the following way, that this is a call from a veteran of the profession to say, we who are value investors, using that term that Warren Buffett doesn't like, mustn't despise growth investors, mustn't be contemptuous of their way of thinking. And likewise, growth investors shouldn't be contemptuous of value investors' way of thinking. But I wonder whether it is realistic to expect those of us whose bag has been through, in my case, about 35 years of investing, to do the things which are so very much not in the blood, and to look at companies with high P ratios, with the sort of micro understanding that you're talking about. And is it not legitimate to say, well, this is my bag, and I'll go on doing it this way and try to be successful at it. And I recognize that there will be people who are doing something quite different, which is completely legitimate and may be successful, and it may even be more successful. But I can't change what is in my blood. How do you react to that, Howard?
Well, no, I fully get it. You know, my reactions to, for example, my son's investments is still what it always was, because it's 50 years of conditioning, Richard. But here's the real question: do you need a partner? If you go back to the book The Money Game by Adam Smith from the mid 60s, this is when the growth stocks were taking off, and there was one old guy in the brokerage firm called the Great Winthrop who had the best performance in his accounts. And so the author said, how could that be? He says, you want to know the answer to how I'm prospering in this market? Come in the back. And in the back, he had 3 kids. It was Billy the Kid and Bobby the Kid and Johnny the Kid. These are my keys, because you got to get yourself a young man. And but certainly, I mean, look, somebody like you or me, it's unlikely that we're going to retread ourselves and recreate ourselves as seers of the future. But the point is, you can get a partnership with somebody who does, and maybe that young partner can do a good job with the growthier things. But the point is, you can stick to your last, but at what price?
Yeah, so there are a couple of questions around tech companies and intrinsic value. So Steve says that, certainly there are many situations where traditional measures such as PE or FCF yield may be too narrow a lens to filter ideas. But given today's environment where many tech companies trade at 30x or 50x sales, not earnings, do you think valuations of tech companies may be stretched? And just to add sort of a note to that, Warren says that, how do you estimate the intrinsic value of businesses? Most people are using non-GAAP measures as Ebitda. What is your take on that?
Well, I think clearly you can't. Just looking at something because it has a high multiple of sales, I mean, it's suspect, but it shouldn't be. It shouldn't automatically exclude it. I think you have to think about the growth rate in sales, what sales are going to get to in some period of time. And if you think it's 15, maybe you want to bracket that at 10 and 20. But what are sales going to be in 10 years? And then what kind of profitability is possible? You can't just look at price to sales. You have to have some suspicion about what a margin could be. And you have to apply that to sales and to produce EBITDA and cash flow. And you have to understand the capital requirements and whether the cash flow is free cash flow or not. You have to understand whether the company is now trying to be profitable or suppressing profitability by spending a lot of money for things like R&D and customer acquisition and that kind of thing. So yeah, you have to think about cash flow. I mean, I wouldn't recommend investing in anything without having thought about cash flow. But yeah, obviously, for a company that's newer and maybe unprofitable, you have to enter into some kind of conjecture. And the question is, can you find ranges for sales and margin, for example, that you're comfortable with? or is it really totally unpredictable? So we're still talking about valuation metrics, but applied to future potential, which is by definition more uncertain than applying it to the present data. And the last question, we all are faced with EBITDA. It's a good concept if you understand you can't just look at that, because you have to understand what the taxes and interest and depreciation and amortization are, what the needs are, and capital needs and so forth. But I think that adjusted EBITDA is really a bad thing, and one of the most important things for us to do is to de-adjust, because how profitable would my business be if I didn't A, or if I could count on B? It's too much conjecture, and we need a base case for EBITDA, and then we can make our adjustments to incorporate our suspicions with regard to the future.